Welcome and thanks for joining us here for Berman's Call. We're here to take your questions on stocks and ETFs today. Here's how you can reach us. Toll free, 1-855-326-6266. You can also email us at bermanscall@bnnbloomberg.ca. Larry joins me now at the desk to talk about what's going on. Larry, thanks for joining us in-house today. Let's talk about the markets. The Nasdaq and the S&P still in decline today. And I'm wondering if you think that's concern about Donald Trump bashing the Federal Reserve Chair.
It's in part, but, you look at the economic uncertainty out there and you hear from businesses and they're all saying it, tariffs, tariffs, tariffs. So that doesn't help that he wants to get rid of the Federal Reserve Chair and replace it with someone who might listen to him. I'm not sure that that's the right path. The more inflation in the system, his policies right now are inflationary. The worse it is for the bond market, the worse it is overall. So I think you absolutely 100% need an independent central bank. Where you have not seen that globally is where you get into really significant trouble. So I'm a strong advocate for an independent central bank, and I think most economists and market participants are. So that's a factor for sure. But the reality is we're likely heading into a recession. It's likely been catalyzed by President Trump's policies. And as I'll talk about in the educational part of today's shows, the good part of President Trump's policies, you better start talking about and fast, because everything right now with these tariffs, there's nothing good in the next 6 to 12 months that are going to come from them.
I was going to say, is there a good part to the policy yet? But you mean the fact that he's promised these things, but he hasn't really discussed it, like deregulation. Less
regulation, better tax rates, et cetera, that are part of the total package that will come if he can get the pay-fors. One of the pay-fors is more revenue. So that's kind of what he's going after right now, in part at least. Okay, so if he does find a way to get rid of Jerome Powell, what would you expect in that aftermath? Last week we saw the market cheer when he tweeted that they're going to delay the tariffs, or it was the week before last on the 9th. So the market can rally, but so far has not been able to be sustained. Why? Because of this uncertainty hasn't left. Yeah, it's deferred, it's kicked down the road, and markets like that, but generally there's still a lot in front of us here, and earnings just aren't priced correctly for even a modest economic pullback.
What are people waiting for? Because as you mentioned, some of the tariffs are paused, some of them have been pulled off the table. I know there's this 90-day situation, so it takes us to about July before we find out if the tariffs are coming back. If this is just a continued way forward for Donald Trump, pressure, pressure, pressure until he gets somebody talking to him or a country talking to him about a deal, is this what we're going to see, this sort of holding pattern continue? Or do you think people are finally going to say, okay, this is just a new normal?
Well, it's the new normal under Trump. This is his style, so markets shouldn't be overly surprised by that. But when it actually happens, you don't like it.
It's a different story.
It's a different story. So we're going through that now. It could be with us for a long time. Torsten Slok, chief economist of Apollo Group, put a note out over the weekend, and he basically said, if you look at historical trade negotiations, they take about 18 months on average. So there's nothing coming anytime soon in terms of great deals. You will see headlines, you will see social media tweets, you'll see all kinds of things coming out of the Trump camp. You saw a few this morning that, we need a little time, but there's great things coming.
Yeah,
right?
And we saw last week, Japan's coming to the table and we're talking about
So the markets respond to that in the short run, but until there's certainty, until there's clarity, people in the C-suite shrug their shoulders. So what do? They get conservative. CapEx gets deferred. All these things that would otherwise be good for the economy just get pushed back as well.
And so it's a paralyzing force that you don't necessarily see changing this year, at least.
What will change it is Congress and the Republican-controlled Congress worried about losing the midterm elections and putting pressure on the president, either by vote in terms of them voting with the Democrats to overthrow what Trump's trying to do, which would require 2/3 of Congress. So we're not there yet. But this last 3-6 months, we're going to be there. And if this lasts 3 to 6 months of uncertainty, we've got a hard economic landing coming. There's no doubt in my mind.
Got it. Okay. We are going to take a quick break here. We want to line up some of your phone calls for Larry. So here's the number again. The number to call is 1-855-326-6266. You can also email your questions in Berman's Call at BNNBloomberg.ca. Thanks for joining us, and we're back in a moment. Welcome back. Thanks for joining us for Berman's Call. Larry Berman at the desk here. We're going to an email first. This is from Rick. He says, "Hi, Larry. I'd like to hear your view on Dream Industrial REIT as a buy." Tell me about Dream Industrial.
Well, an industrial REIT here focused in Canada. And if you think about economic sensitivity and uncertainty around tariff and trade, industrials are got one of those sectors that have a bit of a question mark on it. So I look at times like this as opportunity in the sense that, if it gets cheap enough, it's a strong long-term buy for something like this that throws off a lot of income for investors. Industrial REITs going back 6-8 months ago, to me, very expensive and unattractive. And right now, this should be something for yield seekers out there, should be on the front burner. I'm not saying step out and buy it today, but literally around the recent lows, pretty attractive. Could it get down to $9? Yeah, of course it could.
It's more
right?
of a timing issue, right? Because as you mentioned, everything's so uncertain right now. People are holding on their business. It would be better to wait for clarification.
Well, by the time the market is clear, it would have turned already,
okay.
Right? So market always anticipates to go forward. There's still enough uncertainty in the next couple of quarters that it's not time yet, but it's the kind of environment, put it on your front burner if this is a name that you like, and look to accumulate it when it's weak.
So would you dip in now, or would you kind of wait to dip in sort of a month from now, a few weeks from now?
A month from now, a few weeks from now, it's not a name that's in my universe that we have in our portfolios, but it is a name that if you like industrial REITs in Canada, it's a good quality management, that you buy into it. Into weakness, not into strength when it's overvalued like it was 6 months ago.
Got it. Okay, let's go to the phone lines. Andreas is on the line from Calgary. Hi, Andreas.
Hello, how are you?
I'm good. What's your question today?
Thanks for taking my call. I wanted to know about the company Peabody Energy, ticker symbol BTU. They mine thermal coal and metallurgical coal, and the commodity price is quite low as it is right now, as you know. And I just wanted to know, is it a buy here? And is the company any good amongst its competitors? And I'm just going to hang up the phone here and then listen to your expertise on the matter. Thank you very much. Have a nice day.
You too. So Peabody Energy.
Yeah. So roll back the calendar a couple of quarters. We had earnings in here that were a miss, and we had earnings right in around here that were great. But analysts thought 12 months out, Peabody was worth $30 at this point when everything was great. Okay, that's not the time to buy a stock.
Is that the Trump bump situation?
Post-election, a little bit of a Trump bump for sure. Quarter goes by, bad news, bad earnings right here. Okay, markets already started to anticipate the bad earnings. Now we're looking at an environment where, from a risk return standpoint, but analysts no longer think it's worth its 30 because look at what the stock did. Now they're at 20. Okay, now they could go down. You roll the clock back into COVID time frame under the Biden regime, and this stock was low single digits.
Absolutely, yeah.
Right. So that's the kind of stock you're dealing with. But for the next few years under a Trump administration, it's starting to get very interesting. I don't own the name.
Okay. Let's go to the phone lines then and take another caller. Elvio is calling from Maple, Ontario. Hi, what's your question today?
Hi, Marissa and Larry, and thank you for taking my call. I'm interested in the Hamilton U.S. Bond Maximizer, HBND. Just wondering what your thoughts on that were.
HBND, okay.
Yeah, so using options to invest or add for additional yield into the portfolio. So when you think about what these guys are doing, I love the strategy. But what is sort of misguided a little bit on it is the amount of yield, that additional yield, because you're giving up generally a lot of potential price increase in terms of growth in the underlying name by having a strategy like this. If you look at owning TLT, which is the US long bond, that ETF over the last 2 years has been absolutely flat. It's gone up and down a lot as the bond market's been volatile, and the Hamilton Bond ETF has created a great yield for you, but you actually did worse than owning the TLT. Okay? So you can't just look at the yield component and say, oh, I want some of that. You have to actually understand what it means, and you have to know when to get in and out. I think the bond market is broken as a buy and hold. And I think you need to be a very active bond manager, understanding the impacts of inflation into the longer term, short to intermediate to long term outlook for the bond market.
Why do you think the bond market is broken for a longer term?
We've never had to deal with inflationary concerns for 40 years. Inflation has been something that has been dismissed. It's falling, it's low, not worry about it. Jerome Powell last week said of their dual mandates, employment and inflation, we're more concerned about inflation right now. We want to make sure that genie doesn't get out of the bottle, because if that genie does get out of the bottle, keeping the unemployment rate as low as possible is going to be very, very hard for us. Of course, Trump didn't like that because it means they weren't going to be cutting interest rates in the short run here. This is why you need an independent central bank, and this is why it's different now than it has been for decades.
Got it. Okay, let's go back to the phone lines. And Daniel's on the line, calling from Markham, Ontario. Hi, Daniel.
Hi, Marilla. Hi, Larry. May I have your technical analysis on Athabasca Oil? What are some buy and sell points on the chart? Thanks for taking my call.
Okay, so Athabasca Oil, we will have a look. I want to ask you, too, with oil and the prices dropping, sort of what's your forward look there?
So, I'm a buy when it's cheap guy. So oil prices in the low 60s, in the 50s, I think it's very attractive. Look out 2 or 3 years. Very great trader friend of mine, when I started in the business 30 years ago, almost 40 now, said to me, Larry, sometimes you just got to plug your nose, close your eyes and buy it and look at it in a couple years. So that's where some of these names are. And you want to be accumulating these into periods of weakness. Absolutely. You don't want to buy these things when they're ripping higher, because in the energy space, believe it or not, we're past the best before date. So we're not going to see massive growth in these industries. They're going to be not reinvesting. They're going to be, giving out more of their free cash flow in terms of dividends and buying back stock. You want to accumulate during periods of weakness. And so that's what we're in right now. And, look at the recent lows as, reflection or points that you'd want to kind of get in there.
Are you concerned, or are you thinking it could go lower, considering how much supply there is, the players coming back in, the OPEC taps, Iran, that kind of thing?
So we never know. Remember, just before COVID, Russia and OPEC Plus had this big thing, and they were going to just, I would say, print money, print oil.
Yeah.
There's unlimited supplies. And then COVID hit.
Yes.
And then oil prices went negative. We're not going to see that. But if Russia somehow does a peace deal with Ukraine and their supplies come back into the market, you could see, under a global recession, oil prices come into the 40s, maybe even 30s. Now, they've got to buy back the Strategic Petroleum Reserve, but I think that can get cheaper at some point. So how low can it go? Boy, if I knew that answer, Morel, I'd have all the money in the world, and I don't.
But it could, I guess.
So you always want to keep some powder dry just in case. You want to build your position into periods of weakness so that when it does turn, and it will, at some point. I just can't tell you exactly when that's
So
going to be.
it's a dip-in
can.
situation. Dip in, dip in, dip in.
I think so. And so you got to scale. If your maximum position's 2%, right here, right now, I would have a 0.5%.
Got it.
You know, back at those lows, I'd make it 1%. And if it went deeper, then I could still double up. That's how you got to think about it.
Got it. Okay, let's go back to the phone lines. We have Tom on the line from Red Deer in Alberta. Hi, Tom.
Hello.
What's your question?
I have some cash I'm going to need in 6 months. I just want to park it someplace safe, an ETF, or what did you recommend? Thank you.
Okay, thanks for your call.
In Canada, one of the best yielding ETFs for money market like is a ZST.
Okay.
And that is a corporate bond money market fund where they're buying corporate bonds that mature in under a year. So it's a money market-like instrument because it doesn't have a lot of interest rate risk. There's some credit risk, but a bond that's going to mature, a high-quality bond that's going to mature in under a year, default risk is negligible. It's not zero. But because of that, you're getting paid a yield that's better than any of the high-income savings account type vehicles that are out in the marketplace right now. So highly recommended as a short-term money market solution for people.
Let's see if we can get to one more caller an email from Vano who says, I'm wondering why Canada does not have a gold reserve when it seems every other bank in the world is accumulating it. How do we protect ourselves from currency collapse?
You know, the people out there who are espousing the US dollar won't be there anymore. Like when you sell a US dollar, where is it going to go, right? The Euro region as a currency hub is not stable enough. You know, China is not going to be the reserve currency of the world in my lifetime, I believe. Japan is fundamentally weak, although improving. So when you look around the world and you say, where is the money going to go if people are selling dollars? Right now, today, it's going into Europe, right? Their equity markets are cheaper. Their bond markets are a little bit more expensive at the moment. But money seems to be losing the safe haven status of the US dollar at the moment, running into things like gold. Okay, why doesn't the Bank of Canada and some other central banks not have reserves? Because they determined a long time ago it was better to hold foreign currency assets in terms of foreign government bonds that were paying income as opposed to holding gold. Now in hindsight, looks terrible, but for many years it looked like the right strategy.
I guess the question is, should they start thinking about a new strategy?
Well, so that's the part of the gold bull narrative right now is that all the central banks are now going to rebuild their reserves, right? Well, if they're coming in and buying it, maybe they create the next all-time high that will last for decades once things normalize again. So that time will come, but you've got a debt crisis in the world where every government really has massive debts, and gold is attractive from that perspective, no doubt.
Okay. When we come back, today's educational segment, we're back in a moment.
Berman is one of Canada's top technical analysts. He's the Chief Investment Officer of ETF Capital Management. To learn more, visit etfcm.com. Opinions expressed by Larry Berman are his own and do not necessarily reflect the opinions of BNN, its parent company, or affiliates.
Welcome back to Berman's Call. We're here with Larry Berman. Time for his educational segment. Larry, go ahead.
Big shout out to my wife, Deborah, who just finished the Boston Marathon in her best ever age-adjusted time. Way to go. Really excited for you. Sorry I couldn't be there this time. Torsten Slok, chief economist at Apollo, put out a couple of papers over the weekend. I've been a big fan for a long time. He put out this sort of cloud chart here, all these headwinds to the U.S. economy focused on tariffs. He predicts a 90% chance of recession that's tariff-induced unless they change the way they're doing things. And he lays out a couple of ideas on how they can do that, as many economists often try to offer some advice when they can. But in the typical recession, we see earnings fall about 11%. If you look at the last time we had trade tariffs and they were coming into the economic climate. So last time Trump was around,
2016 or
tariffs went
2015.
up from 2 to 3%, and it caused a headwind to economic growth of somewhere between 1/4 and 3/4% in terms of the drag. But this rate hike or this tariff hike is way bigger by magnitudes. He projects a 4% GDP hit is possible. This is the earnings for 2025 of the S&P 500 going back a few years. And so currently we're sitting here. 245 is the current earnings in the bag. This is what they're thinking for the rest of the year. Earnings are going to be downgraded constantly for the next 6 months. So there's no good news coming here on earnings. And we had suggested that somewhere between 4,200 and 4,800 is where fair value might be based on the multiple and where earnings are likely going to come through in an economic downturn. So there's more to come on the downside here, with almost certainty. How fast are these trade deals going to come? Slock points out that of all the trade deals that have been put in place over the years, the average takes about 18 months, and it actually takes 45 months to implement them and have them go through and be voted on in the respective Congresses and governments. So no time soon is the answer in terms of, don't worry about the tweet in Japan. There's no deal going to be implemented anytime soon. So this is going to be an overhang for a while. It will matter for the midterm elections in the US when Congress has had enough of this. If it looks like the Republican-led Congress is going to be losing their control. Small businesses. Small businesses in the US are about 85% of capital expenditures and about 75% of the labor force. So NFIB, the small business, does a survey, and here's where we got the post-election pop. Sentiment skyrocketed. He starts talking about tariffs. This is the March survey that was not yet April's 2nd's news. So middle of May, we get the next survey. We'll see where sentiment on small businesses, but this is the heart of the U.S. economy, small business. These are companies with less than 500 employees that make up the vast majority of the labor force in the U.S. This is going to be a headwind, and he's got to fix this. He's got to start talking about, less regulation. He's got to start talking about lower taxes and all the bullish parts of his administration's agenda for the markets to really find some calm here.
Yeah, to get some offset.
And
Larry,
he's got to
thanks.
lay off Trump.
Thanks for that. We got to leave it there. That's it for the show today. Thanks for joining us. We'll see you next week.